Gang, welcome to another review of an investor presentation for a SPAC. I've been doing a couple of these lately. They're fun. Today we're looking at SOAC, and we just happen to be in the middle of a little SPAC meltdown. So the financials here will be interesting to look at. And I think this is a good overview of why SPACs might be melting down whenever there's a market correction of sorts. These are risky propositions, and it's not unexpected that they move in line with the overall market, especially with the tech market when there's a risk off movement, as there is right now. So we're looking at SOAC. If you look at SOAC, the Sustainable Opportunities Acquisition Corp, in the last couple of days, they've gone down. Whether or not that's due to the SPAC crash or the market sentiment on the announcement, it's hard to tell. I think it's a combination of both. I don't think people are in love with this announcement. If you look a month back, this thing was trading at 12 bucks before any sort of information was out. So it kind of tells you that, hey, SPACs were really the rage back then. People were buying anything and everything because they thought that there was going to be a pop post announcement. And that really hasn't been the case in the last month or two. We've sort of gone past the everything goes up phase of SPAC investing, and now we have to look more at the company itself to see whether or not it makes sense to hold it long term. For me, it probably, at least at this point, no longer makes sense to put a premium on any SPACs. A lot of SPACs are back to their NAV, basically 10 bucks. Not all, but a lot of them are before announcement, and even those after announcements have really cratered in the last month or two, especially in the last couple of weeks. A lot of SPACs are down quite a bit. If you're in warrants too, you're struggling because warrants have been decimated as well. More than decimated. Decimated is 10%. So decimated multiple times. As they're down, some are down 50% in the last couple of weeks. 6 months back, you can kind of see SOAC was trading at NAV. I bought this one kind of close to 10 bucks, so I was happy to get in on that. I thought this was a decent management team that was going to get something good, so we'll see if that's the case. This kind of ran up with the SPAC craze, and it's sort of back down into the $10 range. So I'm probably maybe slightly profitable here at 10.23. I don't know if I'm going to hold this long term. I do have some warrants as well, which I'm sure have cratered quite a bit in the last couple of months. So what are they getting here? So they're getting the metals company, which they claim is revolutionizing the mineral supply chain for fast-growing EV demand. And I think this is a rename, the metals company, because I believe this company was called DeepGreen, as you can see in their presentation. DeepGreen is the name of the company. And this is their investor presentation. The tagline is "Better Metals for EVs. DeepGreen plus SOAC equals the Metals Company. The Metals Company will list under TMC and trade as the Metals Company." So they are changing the name for some reason. I guess DeepGreen isn't telling you what this company is about, which is obviously metals. So decent team here. Don't know anything about the company itself. If we go to their website, they have a video up there, so we can kind of watch that and see what this company is about. So let's give that a go before we go into the presentation itself. All right, we don't need to watch that again. So they are basically a company that goes to the bottom of the seafloor and collects polymetallic nodules, removes the stuff we need, and then takes them back, and it's a lot less impactful on the environment. So it seems like this was trialed before. There's clearly a way to harvest them and process them into usable metals, even with technology available in the 1970s. It was paused because there was no regulations. And then the Seabed Authority was set up by the UN in 1994, and DeepGreen was granted the first license to explore these nodules. There's more videos here. That's interesting. My first question is, so they got this license in 2011. What the hell have they been doing for 10 years? I don't know this company. They're clearly not a major provider of EV materials at this point. So they do this. Okay, there's a lot of videos to watch here. Is this the same thing we saw? All right, so they have a little ship set up, two ships set up. One of them deals with tiny little machines on the bottom. They they toss up, right? I can't watch videos forever. Kind of got the high idea of they send those little ships down to the bottom and at the ocean floor, which is 4,000 to 5,000 meters deep. They collect most of the rocks, send them up top. Those rocks are moved to the other ship for processing, etc. I'm assuming they get sent back. They leave a few of the rocks just because you don't want to disturb the surface, the bottom of the ocean floor. I'm sure some animals or something depends on those rocks. So again, my question is, it's 2021. What's been going on since they've got this thing? I'm sure they're doing testing like they showed in that first video, but So this is sponsored by Nauru, Tonga, and Kiribati. All right. So it's founded in 2009. So they are the developer of the world's largest estimated deposit of battery metals by the Global Nickel Industry Cost Summary. And so the seafloor polymetallic nodules that we saw with the lowest expected life cycle ESG footprint on the planet and people. So good footprint. The nodules have a lot of metals. So they are giving them 300 million of cash in trust from SOAC. There's a fully committed pipe of 330 million, which is good to see. And it's got an equity value of 2.9 billion. That seems like a lot for something that I'm assuming is producing absolutely nothing right now. Attractively valued with a 2027 EBITDA of 2 billion. 2027. We're getting out there in these projections. They got a net present value of 6.8 billion. 6.8. I'm assuming, I don't know, nickel and third. I don't know what that is. $6.8 for NORI-D. I'm assuming billion. And then net present value of 31 billion for the full portfolio. Oh, they missed a B there. Fire whoever made this presentation summary. DeepGreen shareholders are rolling over their equity. They're going to have 570 million in net cash, assuming no redemptions, expected to fully fund operations to first expected revenue in 2024. So everybody's rolling over. 12% goes to the SPAC and founder shares, not a ton, and 11% goes to the PIPE investors. So they've got again, large source of battery metals, 4 metals in high concentration. There's a low cost of production, and there's a 70 to 99% reduction of life cycle ESG impacts. I mean, obviously, it kind of makes sense if you're picking up rocks from the bottom of the sea. It doesn't take a lot to do that. A couple of boats, a couple of little machines on the bottom versus blowing up mountains and digging holes to get some of these things out of the earth. The other good thing is that a lot of these mines are in certain countries that might have some geopolitical risk, whereas this, I'm assuming, American company, they have rights to certain areas of the ocean to look for this. Again, these areas seem to come from, again, African countries for whatever reason. A lot of this stuff is over there, or at least looked at over there. Still probably some geopolitical risk here. What if they lose their license? The business is done, right? Essentially, their entire business depends on having those rights to those oceans. I don't know how locked in those rights are, but there's probably some risk there. Again, lots of demand for EV. That's the thesis here. Hey, we're going to need a lot of these metals. Here's another way to get those metals. It's going to be deficits in what we are demanding as far as the customers go and what the supply is going to be without a new way of getting these metals beyond the mines that are already out there and up and running. So the solution is, hey, we're going to source battery metals from a vast resource of polymetallic nodules. They're looking at this area over here. Well, I guess this is sort of in the Hawaii zone. Okay. These are the exploration areas. These are projected areas. So these are, I would expect these to be somewhere over here, honestly, but they're kind of in the South America, North America zone, which is interesting. I'm assuming they're all over the place. This is just kind of where they're exploring for whatever reason. This is the contract that was granted by the ISA, the International Seabed Authority, but I'm assuming you could probably look for these anywhere. But who knows? I'm not a scientist. I don't know stuff about rocks. Here's a rock. Looks like a bunny pooplet. You got some copper, some nickel, some cobalt, a bunch of manganese. I wonder which one's most needed. I'm assuming it's not manganese, unfortunately. Seems like they talked about copper a lot and nickel. I think those are the two that are most important. So they're going to mine these suckers for their metals, and I'm assuming toss them back into the earth. So there's going to be a large reduction in impact for the nodules versus land ores. You're using less ore, less land, less water, more of the seafloor. I don't know what kind of damage that has, but a lot less CO2 emissions, a lot less stored carbon, et cetera, et cetera, et cetera. Freshwater ecotoxicity. So seems better. Less child labor, less human lives, less human toxicity. This is important. Less wildlife, biomass, megafauna. This is important. The only question mark is, does this affect the seafloor in a big way? Obviously, they're kind of leaving a lot of these rocks behind. They're hopefully going to return the ones that they mine, but they might not be able to, depending on the mining process. Not the mining process is the wrong word to use. The removal process from the rocks. They might have to destroy the rocks to do that, and they're going to become the second lowest cost nickel producer in the world. Who's first? Somewhere in Russia. Is that a mine? Or Russia's doing whatever they're doing. They're doing right because their cost is cheap. So their portfolio is huge in terms of underdeveloped nickel projects. They got a lot. They're close to the largest nickel operations, which is the one in Russia, apparently. Is that a mine? Why is it so cheap compared to everything else? Again, we're coming back to, hey, they got a ton of potential developments that would give you a full portfolio that's worth about 31.3 billion, assuming a 9% discount rate. And they're going to have a lot of revenue from this and a lot of EBITDA from all of these projects. Wow, what a company. Okay, so this is kind of what we watched before. They sampled some rocks. It took imagery of where the rocks may be, so they know that they're in there. This stuff is governed by the ISA. They were granted contracts in 2011, sponsored by Nauru, sponsored by Tonga. These were granted to Nautilus and acquired by DeepGreen in March of 2020. They have commercial rights in the Mara area. They've got, okay, so this kind of explains why they haven't really been doing anything. They got a draft exploitation regulation issued by the ISA. Now you got final exploitation regulations that are delayed, and they are expecting to adopt a code no later than 2023. And they sort of need those to start. So they have the required contracts to explore our resources, and they are on track to secure our first production contract. So they haven't really secured anything yet. I think this is very much a what if all of this happens, this thing is going to be worth a ton, so let's invest early on. They've got a couple of strategic partners. Maersk is one of the ones. Allseas invested about 70 million to develop a pilot. Part of that was covered by DeepGreen equity, so they're diluting a little bit. And then Glencore invested in 2012, and they hold 50% of the Nori area intake, 50% of the production. So that's interesting. So Glencore is going to have half of what they produce in that area, but they have two other areas they can develop as well that are potentially worth more. So that's one thing to keep in mind, that some of their production is going to go off to Glencore. Glencore is publicly traded, I believe. They're a commodity company. Yeah. So hey, if this stock is worth X billion dollars, I don't know what the market cap is here, but Glencore is going to own half of their production initially, at least. So that's interesting. So NORI-D is planned to commence production in 2024. I'm assuming after they secure rights, after they do all their testing, and expected to reach close to 2 billion in EBITDA in 2027. Is that inclusive of what Glencore is taking? They don't mention anything. So really, they're not going to start producing anything until 2024. By 2020, this goes to 2046. Jesus Christ, what a projection. Net present value is worth 10.8 billion based on current prices as of February 26th. So they're basically going to be earning nothing until 2024 when they start doing their thing. Beyond that, their annual revenue from 2030 to 2046 is going to be 4.7 billion. Ton of EBITDA. Once you kind of get that capex done, whether it's onshore or offshore, going to be a decent amount of profit here. You're net cash flow positive by 2027. You're sort of there until the end of the life cycle here. So that seems great, but this also outlines why stocks like SOAC and SPACs in general are essentially crashing whenever there's a market correction. SPACs and tech stocks and really everything has gone up quite a bit because there's no alternative investments. The 10-year treasury rate was close to zero. Everything else was kind of unattractive. Yeah, obviously, you can go to real estate, but stocks in general were the preferable means of investment for many when the bonds are so unattractive, right? Even if you're pricing at a 35 PE, that's still a 3% earnings yield with potential to grow. If your 10-year is 0.5%, why would you invest in the 10-year? What's happened since then is that inflation worries have arisen. The 10-year has gone up from 0.5 to 1.6%. A bit more interesting, and with the fear of that going up higher, stocks have corrected. And what's correcting is stocks that are basically priced based on assumptions, right? A stock like this is essentially all assumptions. You have no revenue until 2024. You have no product right now. And you're paying $2.8 billion for that if you buy a 10, $2.9 billion for that if you buy 10 bucks. That's a risk that many aren't willing to take anymore, right? It's a lot easier to take on a risk when there's no alternatives. If you believe the market's going to give you a 3% return and something like this can potentially give you a 100% return, and there's no alternative investment in the form of a bond that gives you any sort of guaranteed uh, growth, then maybe this is interesting, right? If that starts to change, if stock prices start to come down because bonds are coming down and people are less willing to take risk, that this is more of a risk off market versus a risk on market, which we had in the past year, stocks like this will get punished. SPACs will get punished. And the reason for that is people are taking a lot of risk with investing in something like this, right? Because you're essentially saying that, hey, I am trusting these companies that are all sort of like this in recent memory, that they will execute based on what's shown in this presentation, right? This is a company that has nothing going on right now. They have some rights to explorations, they have no actual production contracts in place. So it's like, I'm buying the potential here, right? I'm not buying something that's a known entity in a risk off market like we have today, where potentially yields are rising, people are going to invest in known entities more so than unknown entities because they're unsure of what's going to happen a year from now, right? If you're unsure what's going to happen a year from now, you're not going to be wanting to invest in a company that's projecting for something to happen 3 to 4 years from now, right? There's a lot of uncertainty in the market today, and that makes people less likely to invest in stuff like this and SPACs in general, because a lot of SPACs are like this, right? You're looking at some of these presentations, and while some companies, like some of the other ones we looked at a couple of days ago, have some revenue in 2020, 2021, even those that do, the revenue is relatively small. Some actually have a decent amount of revenue, and I'll cover more of those later. But companies like this are really basing their pricing on 2025, 2026, 2027 projections, and that's so far out that the risk with these companies is huge, right? They're getting a lot of money, but they're getting a lot of money on the basis that this is going to happen. And what's happened in the SPAC world in recent times is that there are so many SPACs that companies that probably aren't anywhere close to being ready to go public are being taken public by SPACs like this one. Like this company is probably, a couple of years ago, they'd probably be in that like Series B, hey, give me some money so I can exist for a couple of years to see if this thing actually works out. And when I'm actually generating revenue, maybe then I'll IPO and go public. But SPACs have allowed companies like this to say, hey, or really the SPACs have approached companies like this and say, hey, I know you have this potential. Let's make a deck, and I'm going to give you 600 $1 million in cash via pipe and the money I have and value you at $3 billion, right? $3 billion pre-revenue, $3 billion pre-product, really, right? They have something, they obviously have an idea, they obviously have rights to look at a certain area and explore and potentially eventually dig there once those ISA um, things are completed, but they don't really have a contract right now. I don't even know if they have those ships ready to go or if they're still creating them. I don't know if they have those tiny little bug ships at the bottom of the sea. This is like one of those futuristic ideas that says, "Hey, there's rocks at the bottom of the sea. Let's go take them and mine them, and we're going to make metals out of them because metals are needed right now." And it's amazing. And yeah, it could be. I'm not saying this to disparage this company, but this 10 years down the line, this thing could be actually generating $5 billion in consistent revenue year over year. They could be getting their second program up in line, and this could be, $100 billion stock if that's the case. Like if the market cap of this is $100 billion in 2030, and they're actually doing their thing, and that market cap is growing every year because they're getting their second exploration area underway, then it's like, it could totally happen. I'm not saying it can't happen. It could totally happen. That's why these SPACs are so interesting sometimes to some of these investors because they can throw in some of this money, and it's not really their own money; it's investors' money, and they get shares for it, and they can say, "Hey, if this thing works out, I'm gonna make a ton of money. I can have a 30x return." And that's kind of how Series A, Series B funding works, and that's the space we're getting into as SPAC investors, right? We're getting into the venture capital side, which I like in a way because you can choose projects that you could believe in if they're close to NAV and kind of roll the dice. But the reality with this type of space is that if the die fall the wrong way, you're going to go to zero pretty quickly, right? If these guys lose their contract, this is a zero company. If these guys don't end up, if whatever they're expecting to happen doesn't happen, this thing's gonna tank. But on the opposite side, you're investing a little bit of money for the potential to get a massive return, right? So that's what venture capital investing works like. The problem is that 80 to 90% of the time, you're going to get no return, right? These companies are going to go under. Their expectations are going to be nowhere close to what they're showing on the page. But maybe 10% of the time, this thing's going to blow up, right? This $2.9 billion company could be $100, $200 billion in 5 to 10 years. Maybe not 5, but 10 years. If this thing works out, hey, boom, you're in the money. If this thing goes sideways, hey, you're basically going to zero. So that's the kind of risk you're taking here, and that's why SPACs have been beaten down because so many of the recent SPACs are kind of this story. So many companies are competing. There's 200, 300 active SPACs. They're going after less and less companies every day, and they're valuing these companies as if they're mature revenue earning companies, right? You're basically paying 12 to 13x 2024 revenue, right? That's somewhat expensive, yeah, for a company that hasn't proven anything. We sort of saw a similar thing with Lucid, where it's like, well, these guys don't have anything on the road, but they're being valued at $30 billion. That's excessive, and they're being valued off of the back of Tesla, which is also valued at a high rate. And this company, given that it's in the EV space in a way that they're producing things that are going to help EV, and if EV is going to break out in a big way, there's certainly going to be demand for these metals, and I think that's a given at this point that the EV space is going to keep growing. And if they can execute on this, boom, you're looking good. The problem is that your starting point's a bit high, right? Because of how SPACs have been doing these days, they have to pay more and more money to get these companies to go public. They have to give more money to the current shareholders to have them go public. And it's probably honestly too early for some of these companies to go public, but this is what's happening, right? The good thing with this format is that it gives you or me, the investor, the ability to get on the ground floor with some of these companies, because if these companies were seeded normally, they went through Series A, Series B, Series C, Series D funding. By the time they're ready to go public in 2026, they might be going public at like a 30, $40 billion valuation if their revenue is where they claim it's going to be at that point and their growth potential is still there. So that's less enticing at that point because it's kind of a mature company. But at that point, you also know that this thing won't die somewhere in the middle of this range. oh, some of these companies could probably go under. Probably won't because of the cash infusion they're getting. But if by 2024 they're still at zero revenue, you think the market's going to value these guys at 2.9 billion? Probably not. If by 2025 they're not there yet either, you're going to start wondering, hey, is this ever going to materialize? If they don't have a contract in place by 2023 to get started in 2024, it's going to get punished by the market. So there's so many uncertainties on the road to 2027, which is what they're claiming. They're going to have 2 billion EBITDA and what they're valuing their their company off of. Who the hell knows what's going to happen by then, right? So you're taking that huge risk by holding this company, and that's that's something you have to understand, and that's one of the reasons that SPACs have been killed in recent memory, because so many of these SPACs, not all of them, there's probably a couple of good companies being thrown out with the bathwater in there that you can buy at a great price, but you have to kind of realize that some of these pre-revenue companies are valued at a pretty decent multiple of future revenue. And if that revenue doesn't materialize, these things are going to go well below $10, right? So that's the risk you're taking. On the opposite end, if the revenue materializes, if they are actually at 2 million EBITDA, if they're starting to get positive cash flow by 2027, then, this thing's a pretty good value at this level, right? But so many ifs here, and especially with a presentation like this, they're going through 2046. I mean, that is a lot to take in, right? That 20, it's a lot, right? But if you believe in something like this and you think it's feasible, reasonable, if the management can execute, you're getting a company at basically their net cash flow of 2031 today, right? So you're getting it on the ground floor in something that could be really impressive. But who the hell knows, right? So that's that's really where I'm going. And seeing these kind of financial projections all the way through 2046 kind of says, come on, man. It's like, who the hell knows what's going to happen in 2027, right? And that's kind of where a lot of these projections stop. These guys are going all the way to 2046, and it's like, I mean, that's a bit excessive. So again, we're going back to, what are these guys worth? 2.9 billion in market cap. Um, they're getting a bunch of cash, assuming there's no redemptions. 2.3 billion in enterprise value. Again, a good valuation if you believe the 2027 EBITDA, but there's so many ifs and buts in there. Um, so they have. It's good that. So a couple of things I'll mention. One, the SPAC investors are only getting 10% of the company. That's probably less than I like to see. Means that there's a lot of PIPE investors in there. Means that they're probably valuing the company a bit higher than some other companies that have been valued in a certain way, because the SPAC dollars are less worth less in relation to the valuation of the company than some other SPACs that I've seen. Another good thing is that it seems like they're setting up their earnouts in a way that's investor friendly, and it says that there's going to be more shares issued at X, Y, and Z prices, and see appendix for details. Sometimes the earnouts are basically, hey, you're getting shares anyway. Um, but over here, there's a price target for some of these earnouts that, hey, we're going to actually be able to sell some of these shares at a certain price, that they're going to become available to us, and we're going to get more shares at another price. So they're going to get more shares at $50, right? So there's an incentive for this company to raise their price, because existing shareholders and the sponsors are not going to get all of their shares until X happens. Um, and they're going to get more shares if X happens. So that's pretty decent. It does dilute the company, as SPACs do anyway, but at least it's not diluting it immediately. It's diluting it if certain things happen, and some of these earn-out prices are pretty decent in terms of $15, $25, all the way to $200. So there's incentive for not only the shareholders of the metals company right now, but also the sponsors, SOAC, to see the price go higher. So it seems like at least they believe in the company in order to set it up that way, because otherwise they'd just be like, give us all our shares right now. Let's gobble them up. Let's dilute the individual investor, and let's screw them, which is what happens in certain SPACs quite often. And that's why SPACs don't do that well long term, because you're getting diluted right away as an investor. Somebody else is in there taking a good piece of the pie, and they're also getting more shares, and the warrants are out there as well that get executed. So there's dilution going on all over the place. Then the other nice thing that I like about this company is that Sometimes you'll see cash just going to investors or cash just going to existing shareholders and they're selling out. Over here, nobody's selling; they're rolling over all their equity, and 570 million of the 630 million in cash goes straight to the balance sheet, which is good to see as a shareholder. You want that to happen. You want the company to get something out of the deal. You don't want just the deal to be investors or early investors getting the hell out via taking a payout, because it doesn't benefit the company in any way. Here, it gives the company money to invest in whatever it is they're doing. In this case, building tiny little ships to go on the bottom of the sea and collect rocks, which is cool. So again, we're valuing this thing at X at $10.8 billion using current spot prices, but you also have all these other things that are potentially in development, um, and all that is worth $38 billion. They're doing like a future value analysis of what this is worth based on the NORI standalone valuation on current spot prices. Assuming a 8 to 10% discount rate, you're sort of getting, hey, we're worth between $19 and $31. And right now you're getting this thing at $10 a share. All of this is, hey, future expectations. If they can actually, I don't want to use the word mine, but let's say if they can actually collect all these rocks and extract all these um, metals like they claim, then yeah, this makes sense. But who the hell knows? It's such a futuristic idea that sounds cool, but if they can't execute, none of this is worthwhile. So what's their valuation? Again, they're basing it on 26, 27 valuations versus EBITDA. Much better than everybody else, of course. All of these SPACs look this way, but you have to sort of, um, is this realistic? Is kind of the question I ask myself. I don't know. It's so far ahead of the curve. Like I said, this company's going early. So this company's going public so early in their life cycle, as are many SPACs, that have you basically have to know that this thing can go to zero if you're an investor in it, right? And you have to be okay with that. And I think that's the case with a lot of SPACs, that you're taking a bet on something that may not materialize, but if it does, it can be worth 10 to 20x of what you have out there. Right, and they're kind of showing that here. If we have more of this stuff, if we take their multiple up based on what the other metal producers are, hey, we could be worth $73 a share in the future based on a higher multiple. Right now it's $10, right? So you're saying, hey, maybe in 2027 we'll be worth 7x of what we're getting. That's pretty good. Um, and again, SOAC had some buzz as a good up and coming SPAC back in the day. That's kind of why it traded up to $12. It's back down to $10. So you're not really paying anything higher than the NAV at this point if you're buying today. And you're getting something that's in an interesting zone that does something different than what some of these other EV area players are doing. Right? This is probably the only company you can invest in that's collecting rocks from the bottom of the sea and putting it into batteries in a couple of years, right? And if you believe in EVs, then this is an interesting way to invest in them, because it's sort of the production side of things. They're not selling you a car, but they're being involved in the production of that car. And if the demand does eclipse supply in a way that they showed, and these guys can kind of reduce that difference between demand and supply, they can probably make a lot of money from this if they can execute, right? Um, and spot prices can always go up and down, right? So these are obviously projected on what nickel, what copper costs right now, and if those go up, the valuation here could be much better. If they go down, it could be worse. But if they can execute on this, I think this is an interesting investment. Obviously, if they can't, it goes to zero. So that's your sort of your appetite. Um, a lot of contracts, blah blah blah. A lot of random dudes here. Very good. SOAC believes in this company, right? Let's go kind of down to, all right, again, back to market cap versus fundamentals. And this is NORI only. So again, they have more of these things that are out there. again, so this is kind of what I was talking about earlier, that this is in high risk jurisdictions, whether it's Indonesia, whether it's South Africa, Congo, Chile. Um, these guys are kind of mining off of the coast of Hawaii, at least it seems that way. So that's interesting in terms of where they are. Maybe they are saying that, hey, ours has less geopolitical risk here than some of these other things where the production is so centralized in certain countries, right? You got Australia, Chile, China pretty much making all of the lithium. You've got Iran, US, Russia doing most of the natural gas, similar for oil, where it's three or four countries doing like 50% plus of a lot of these metals, whereas, hey, we're doing something else. And this is the thing I talked about, that there's different tranches, there's incentives that are aligned with shareholder value in terms of how um, earnout shares are structured. But it also means that there's more dilution coming if the price comes up a bit. Um, but the biggest tranches, the most dilutive tranches, um, are really $50 plus in terms of when they can cash them out. So if the stock never reaches $15 or $25 or $30, there's going to be no dilution. Once it reaches 50, there's going to be more dilution all the way up to 200. But hey, if it's trading at 50, they can take whatever they want. They're clearly doing their job. If it's trading at 200, they can get more shares. They're clearly doing their job. So a lot of that stuff means that, hey, there's going to be more dilution down the line, but it's not bad dilution, right? Sometimes dilution is right away where it happens with no actual investor alignment. Over here, there's an earnout structure that's aligned with investors in terms of, hey, we have to get the share price to X before we get additional shares. That's good to see. I like that as a shareholder. Um, and then, hey, we're going to have a lot of rocks down there. So the reality is that this thing is going to be an ongoing um, business model, because again, their stuff's going to keep going down. This is their Nori D project only. They have two other projects that they have rights to. I'm assuming if they can prove that this is actually viable, they'll get rights to more projects. There'll be other companies that enter this space if they can prove this is viable. So there's going to be some competition. But if they're the first mover, if they have multiple contracts in place, it's possible there are other companies that are doing this sort of gig. They didn't mention those here, and I don't know of any, but they're clearly the ones that SOAC thought were the best of breed. Um, and they've got a lot of production capacity in their projects, at least estimated production capacity. And that'll be interesting to see how it plays out. And that's it. That's the company, that's the investment. I think, am I going to hold this? Honestly, I think so. If it goes up in price, if SPACs start sort of getting hot again. I don't know if that's going to be anytime soon. I think we have to wait for the 10-year to kind of stabilize or go down for that to happen. Might be a while from now. If this thing somehow explodes and it goes to 20, I'll probably share half my position and kind of let the rest ride. But for now, if I need some cash cleared up, I may I may sell a bit, but I think I'll definitely hold a little bit here. I think it's an interesting proposition. It's just so far out that it's a risky bet, and that's what you have to be cognizant of. That if you're buying this company, even at $10, even at if it goes below that, this isn't one where I would back up the truck if it suddenly goes below $10 after a merger. This is one where you have to wait for the thesis to play out. And if it plays out, you're going to make a lot of money. And if it doesn't, you're going to lose your initial investment. This is more of a venture capital bet than anything. And this is something that I'm seeing more and more with some of these SPACs. Um, so, that's my take on it. I'll hold knowing that I could potentially lose all this money, but also knowing that it could go 7x pretty easily if some of this stuff is accurate. And I don't have a big position in here. This is the one that I would take a huge position in because the risks are very high, I think. And this is unproven technology. It's kind of futuristic. If you look at some of the other SPACs, it's like, hey, we're making a car. Cars are already on the road. Here it's kind of like, hey, rocks on the bottom of the sea. We're gonna take them. We're gonna make metals out of them. Money. It's that sort of thing. And it's a weird business. It's not one I'm familiar with. It's not one I could analyze well, but it's like, hey, if I want to take a small bet on something, this seems interesting. Why not? I could potentially make a huge return. Why not do that? Um, and this is such a small percentage of my portfolio that it doesn't really matter in the long run if it goes under. I'm assuming a lot of these SPACs that I hold, they're kind of bets on the future. There are 2027 estimated valuations. I'm assuming like 90% of them are just going to fall flat and do nothing. But I'm hoping that the other 10% have like a 10 to 20x return and can still mean that I'm doing well overall by the time we get to actual revenue for some of these companies. If 90% of them fail, but 10 to 20% of them go 20 to 100x or something ridiculous like that, you can still make money on propositions like that. Um, it's just that, hey, if all of them don't do well, you're kind of screwed. So keep that in mind when investing in SPACs. It's a risky proposition, and that's certainly been the case in the last couple of weeks. All right, guys, thanks for watching. One thing to note, I am not a qualified financial advisor. Please make sure to talk to a qualified financial advisor before you make any investments. This is just for fun. I do have my own money in play. I am long all of the stocks I discussed today. I may buy and sell at any time. And again, talk to a financial advisor. This is just me having some fun looking at some of these investment presentations, including one for revolutionizing the mineral supply chain for fast growing EV demand through rocks. Guys, thanks for watching. Hope you enjoyed it. Thanks for all the likes and subscribes that I've gotten in the last couple of days. Keep them coming. Again, investments come with risks, so don't make them lightly. Thanks for watching and have a good rest of your day.